Good morning, everyone, and thank you, Patrick, for that kind introduction. I've known Patrick, I think, for the 40-odd years that I've been working as an economic consultant. I studied at, well, I didn't study with her, but I met Patrick's lovely wife, Belinda, at university back in 1977, I think it would have been, and we've been friends ever since. So I'm an economic advisor. I've been working for 42 years in the industry. During that time, I've had the good fortune or bad fortune, depending on how you might look at it, to have visited and worked on pretty much every shopping centre and every supermarket in the country. So I've got to know every corner of Australia, every city, every town, every rural region, which has been a fantastic treat for me. That's certainly an aspect that I've enjoyed. Unlike a lot of economists that you might see on the television, who talk about macroeconomic things, my focus has been really as a micro-economist, and I've specialised in the property sector. Commencing initially with retail, shopping centres and retailers, and for 25 years between 1990 and about 2005, I did all the network planning for Woolworths supermarkets and Dan Murphy's and Big W stores and all the Woolworths brands. But increasingly over the last 10 or 15 years, of course, the nature of retail has changed and retail development has changed, and so developers have become more and more interested in what we call mixed use, which involves potentially a little bit of commercial, a little bit of office, but increasingly residential as well. So the residential market has become increasingly important and the focus of what I do. But it's always been important anyway, because retail, and particularly supermarkets, but all kinds of retail, is dependent on people. And so, where the people are going, where the population is increasing or decreasing, what people are doing, consumers, what they want, how much they've got to spend, what they spend it on. These are all things that have interested me for the last 40-odd years. Now, it has been said about economists, and you might have heard this, that if you were to lay all the world's economists end to end, you might still not reach a conclusion. I try not to be like that. I try not to be on the one hand, then on the other hand. And so I will give you my views and my conclusions today. But of course, none of us can tell the future. It's not an easy thing to do. But I think when it comes to trying to predict the future, what tends to happen a lot in my experience is that the most recent past, the things that are freshest in our minds tend to be the way we then project things forward and think, well, it's been like this the last 3 months or the last 6 months or the last 12 months, so I can't really see it changing. And so I think there's a lot of that goes into, the way that many try to predict the future. And it's not particularly helpful because, of course, we know that things change for all manner of reasons. And so what we try and do, or what I try and do, is go beyond just the obvious and the immediate, and really try to come to grips with what might happen and the reasons why. And because the focus of what I understand OYOB is about is essentially residential property and residential development, that's what I'm going to focus on today. And it is all about people, of course. Whether we're talking about houses, whether we're talking about shopping centres, supermarkets, whatever, it's certainly people that create these opportunities. And as you would all know, what happened in Australia, and particularly in Melbourne, is that we saw a massive dip in the number of people coming to Melbourne, the growth of an increasing population of Melbourne and in Australia generally, as a result of the COVID pandemic that we've all just experienced. But in its most recent statement following the pandemic, which was only released in January this year, the Australian Centre for Population Studies has made a number of important points, as you'll see there, which are, first of all, that we are very quickly going to get back to the annual level of net migration to Australia that we experienced for many years pre-pandemic, which is in the order of 230 to 240,000 people per year, and which contributes about 2/3 of our annual population growth of about 350 to 400 people a year. Natural increase, which is about 1/3 of our growth, 120 to 130,000. That hasn't really changed during the pandemic. That's continued and that's projected to continue. But the existing population is generally having fewer children, so it's trending down slightly. And I'll talk a bit more about this on the next slide. Melbourne is still projected to overtake Sydney and become Australia's largest city in the not too distant future. A year or two later, perhaps, than might have been thought pre-COVID, but by about 2031, 32, which is what, 8 or 9 years away, Melbourne's population will reach 6 million and it will become the largest metropolis in Australia. And if we have a look specifically at Melbourne, which is obviously, I imagine, a focus of OYOB, Melbourne's been one of the fastest growing, what's been the fastest growing city in Australia by a long, long way for many, many years. And as I said, I've been doing this now for 41 years, so I've been through all the ebbs and flows when I first started in 82. You know, Melbourne was a place that was very rapidly losing its economic lustre at that time, and then we had the period of the early 90s where people derisively referred to Melbourne as the rust bucket city. I don't know if any of you remember that, when we were really, really struggling and were losing businesses to Sydney. The financial companies all tended to sort of leave Melbourne and go to Sydney, etc. Our CBD was struggling. We didn't have much population growth. So all of that changed about 15 years ago, and Melbourne steadily then improved its position and became by far the fastest growing city, the most sought after city to live in Australia by a long way, with its population basically increasing by around about 100,000 people per year for the roughly 15-year period prior to COVID, which means that the city added in excess of 1 million, about 1.5 million people to its population over that decade. And you can see that's a lot of people, and that's a lot of dwellings that are required. That all fell away dramatically, and Melbourne copped a lot of flack during the COVID period, and we saw our population decline significantly in 2021. Whilst it still increased in 2020, which was the first year of COVID, but not by nowhere near as much as it had previously, and then we saw a significant decline in 2021. Started to recover pretty well last year in 22, where we got back to about half the level of population growth that we previously experienced, and projected to be back to normal essentially by financial year 23, and then to continue at about 100,000 people per year going forward. So back to what we were pre-COVID very, very quickly, really. So the bottom line is that we've lost between 2 and 3 years worth of growth. Our population would have probably been around about 250,000, give or take, greater today than it is had COVID not happened. But in terms of the growth going forward, there really is there's no impact expected or likely. And that's been the case across a lot of things post-COVID. I know during COVID, of course, no one really knew where things were going. We were all very, very concerned, and so a lot of, again, I come back to, all people could see was what was happening then, or what had happened in the month or 2 months prior, and that's how they projected. So you might recall that apparently, as a result of COVID, we were never going to shake hands again, we were never going to hug people again, we were never going to eat from a bain-marie again. Everybody was going to leave their job and go to the country. And guess what? In the last 2 years, the number of people who have changed jobs, as the ABS statistics show, has been no different to what it was pre-COVID. So everyone made all sorts of prognostications, based on the emotional feelings that they had at the time, and essentially none of those things have really come true. And I kept saying, during COVID, you know what, there were good reasons why things happened the way they did before. There were good reasons why people wanted to live in Melbourne. There were good reasons why they wanted to live in Sydney, not as much as Melbourne, but in Sydney as well, and in all of our state capital cities. And those reasons aren't going to disappear just because of COVID. Yes, we'll be battered and bruised, but essentially those reasons will all be there because they were good, solid reasons. So apart from people, of course, economic well-being is also important in all of our markets, including the residential market, and there's been a little bit of, there's obviously been some concern, particularly in this last year, around the state of the economy, given what's happened with interest rates, given what's happened with inflation. I'm not going to show you the RBA forecast because they haven't exactly covered themselves in glory in the last couple of years in terms of their projections, particularly about interest rates. But the IMF basically sees Australia's economy going forward from 23 onwards as being steady, if a little unspectacular. Our GDP growth, our real GDP growth, which, in a good year, we like to see it between, say, 3 and 4%. As you can see there, in the really bad COVID year of 2020, we went backwards 2%, but in the very next year, we increased by 5%. So the economy has actually been pretty good. It recovered very, very quickly. And in 22, 3.8%. Going forward, because there are some concerns, we're expecting, or the IMF is expecting our economy to grow at around about 2% a year, which is a little on the low side, but nonetheless good, steady growth. Importantly, inflation is in Australia, whilst it has concerned us, it's been nowhere near as bad as in other economies, in particular in the US. Yes, we've got up to 6.5% in 22, but we're expected to be back to our 2 to 3% range, basically within the next year or so by financial year 2024. And the unemployment rate didn't balloon, it increased a little bit during COVID, but nowhere near as much as was feared, and is going to be back to around about 4%, 4.5% going forward. So our economic performance, our macroeconomic performance is projected to be solid. Not spectacular, but certainly solid. If we have a look at interest rates and inflation, both of which are obviously very important for homeowners, the two go hand in hand because interest rates, of course, impact directly on what typically is the biggest expenditure for households or who purchase homes, which is their home loan repayment. And of course, inflation is also an issue because it impacts on everything else that they buy, their food and groceries and their travel and education and so on. Yes, our interest rates have jumped up to about 5%, which is significant but primarily because they were so low for so long, and arguably, in my view, too low. And I think the Reserve Bank had them too low for too long, and as a consequence, it's been a bit of a knee-jerk reaction where I think now, in part they're being forced to overreact, but also my personal view is that they're being excessive in terms of the interest rate increases. But that said, it's still only 5%. I know when I bought my first home, my wife and I bought our first home back in I think it was 83, in just up the road in North Baldwin. I think we were paying double-digit interest rates at the time, as we did for many, many years. Those of us of my generation. So 4 or 5% is still not a particularly high interest rate, but certainly it's a high interest rate compared with what people were used to over the previous 4 or 5 years. But the good thing about interest rates and inflation is that it does appear that both have more or less peaked. There's a lot of confidence out there now from all of the forecasters that essentially inflation is certainly trending down, and if interest rates haven't peaked, then there's not that far to go, perhaps another 250 basis points in Australia, after which they're expected to trend down again. So that's all good news. So the outlook from here, a little bit surprisingly, the US Federal Reserve increased rates only 2 days ago by 250 basis points. So it was a bit of a surprise, but it was in reaction to the fact that they saw their economy as being very strong and felt that they still needed to dampen things just a little bit. But the banking crisis that we're seeing unfold in the US is certainly another reason why one can be confident that interest rates are unlikely to go up terribly much further. Headline inflation, as I said, is already trending down, particularly in the US, from where we tend to take a bit of our lead. And the Ukraine war, which is one of the big factors in driving up inflation, caused various supply shortages. There's an index that measures the extent of those bottlenecks, and that index is now back to pre-Ukraine war levels. So there are a lot of reasons why I think we can be reasonably confident that both inflation and interest rates are now under control. So another measure of the general economic well-being of the nation and the state is, of course, retail spending. And amazingly, and when we look at retail spending, we tend to analyse it in seven categories: food, cafes and restaurants, what we spend on apparel, clothing, which is clothing, footwear, etc., household goods, leisure, general retail and retail services. And one of the hallmarks of the COVID period was that, in fact, retail spending boomed. Unlike what most people thought would happen, it actually boomed. It increased by about 6% in the first year of COVID, and then by about 9% in the second year of COVID, which is pretty amazing. And it was because everyone was at home. We were fortunate enough to still be able to, most of us, to earn salary or earn wages, and of course there were significant top-ups by both the federal and state governments, and so consumer spending, retail spending, actually went through the roof and was significantly higher during the COVID period than it had been in the years prior. And it's remained high in the immediate post-COVID period. The 6 months to December last year, it was up 13% on the prior year. And you might say, well, that's all going online now, isn't it? And the answer to that is no, not really. Yes, that was the case for 2020, that horrible year. We were all too scared to leave our homes. But only for 2020. It's really come back to normality essentially since. And the other thing about the online transfer anyway is that about 2/3 of online sales, online retail sales by Australian consumers, are directed to the traditional retail businesses anyway. It's still Woolworths and Coles and David Jones and the various specialty fashion stores and fashion chains and so on that get that business. Because they've all become very good now at having online channels, and like me, I imagine that most of you or all of you would be well aware of that because you're probably using them and buying stuff online. And so their online channel now is just another aspect of their total business. And interestingly enough, what we're finding now is that a lot of retailers post-COVID are looking for more bricks and mortar stores. They actually want to grow their bricks and mortar footprint because they see online and bricks and mortar going hand in hand. One drives the other and vice versa. And so yes, online retailing, yes, certainly jumped during the pandemic, but is now basically flatlined since. So let's go to the residential sector, which is the sector I would imagine of most interest to most of you. I don't know whether you're all aware of CoreLogic. You probably are, but CoreLogic provides fantastic detailed data on the residential sector. And first of all, it is the store of value for wealth for the majority of Australians, and by far the most important in Australia. That gives you a bit of a guide there. $9.3 trillion of wealth is held in residential real estate, compared with 3.4 trillion, about a third of that in superannuation, 2.8 trillion in Australian listed stocks, and 1.3 in commercial real estate. So the residential sector is of massive importance to the growth and well-being of Australian residents. And yes, Australia residential values did trend down in the year following, the first year following the pandemic, but that was after massive jumps during the pandemic period. And the rate of decline has really eased off, and now we're basically in a plateau situation where essentially there's no further decline. So there's been an adjustment of probably 7 or 8% in dwelling values, but as I said, that was after massive increases during COVID. So really, in the scheme of things, in my view, it's something that was not unexpected, and is not something that would give me great cause for concern. And as you can see there, in capital cities and including in Melbourne, what we're finding is that essentially, over the last couple of months, the rate of decrease has slowed, and we're now back up to seeing house prices plateau, and in my view about to start increasing again in the not too distant future. Certainly once people are confident that there are no more interest rate rises coming, and that in fact there is a likelihood of interest rate decreases starting again within the next probably 6 to 12 months. Once people are of that view, then I think you'll see strong confidence come back very, very quickly in the residential market. Again, this is another measure of how things are travelling, the rolling 28-day growth rate in daily home value index. And as I said earlier, you can see what that is telling us, that we're now back to a position of neutrality, where the decrease in home values is essentially finished, and from here I think we can expect to see increases again. We have a long history of this, and I've been observing it, as I said, for the last 40 years in Australia, and many international groups, typically will project that home values are going to go down by 20% or 30% in Australia because of this factor or that factor or some other factor, and it just doesn't happen, because Australian households, we are wedded to the idea of owning homes. It's our main, as I say, it's our main store of wealth, and the sector is robust, and if we have population growth coming back, which is obviously an important driver, then that gives one great confidence that all of those good reasons will continue. For Melbourne specifically, Melbourne house prices decreased by 9.6% over the last 12 years, but 2.7% over the last quarter, and 0.4% in February. Again, the same trend. Yes, they did go down, but that rate of decrease is now well and truly stabilised, and we're back to essentially a neutral position. And the other thing about the residential market, of course, which is going to keep it strong, is that rentals have gone through the roof. And I don't know, a lot of you have probably got children who are looking to buy homes or to rent homes. I've got 4 kids, and 2 of them, a couple of them have bought their homes, two two younger ones are looking to rent in Melbourne, and it is extremely difficult for them. They can't find places, and B, if they can find something, it's way beyond their budget. So they tend to stay at mum and dad's apartment, so that mum and dad don't get to use it very much. I know you also, I think there's also some investment in childcare. I'm not going to talk too long about childcare, other than to say that at Gap Maps, where I work as head of Gap Advisory, and Gap Maps is a digital research platform, we pretty much all of the childcare operators across the country use Gap Maps and use it to help them determine, where to open new centres, etc. We have a lot of detail on demand and supply of childcare centres, average daily rates, all of those things that help them to determine where there is demand. And as you would know, there are many areas of Melbourne where we still need more childcare centres. We classify them as areas of oases versus deserts for childcare, and typically the main ratio is the number of kids of childcare age, 0 to 4 or 0 to 5, relative to the number of places for long day childcare that are available in a given area. And if that ratio is higher than about 2.5, then there's likely to be demand for additional childcare facilities, particularly if it's also an area of population growth where younger families are moving in. And certainly if that ratio is 3 or more, and in many areas you'll find that it's 4 or 5 or 6, meaning that there are 6 kids of childcare age for every available long day childcare place, then that signifies that there's a need for additional centres. We also look hand in hand with that, the average daily rate for childcare. And ideally, if you're looking to build something, you want an area where the average daily rate is in excess of $100, preferably 110, 120 or even higher, and where the ratio of kids to places is in excess of 3. And if you meet the way the childcare operators that use Gap Maps tend to operate, they find those two metrics particularly important to them. So if you tick both of those boxes, then you've got a pretty good area for a new childcare centre. So, as I said, a lot of it has been said about economists that if you make them into any of my still not reached a conclusion. I do try to reach a conclusion, so I'll give you my very, very brief summary of how I see things. I think that the outlook for population growth, which is fundamental, obviously to the residential market, but to the commercial market and to the retail market as well, I would rate that now as 9 out of 10 for Victoria and for Melbourne in particular. I think we are almost, or we will very soon be back to the good old times in terms of population growth. The outlook for the broader economic outlook, the broader economic conditions, not quite as good, but still solid. As I said, not spectacular, but solid. I'd give that a 7 to maybe 7.5 out of 10. Very good evidence that we have peaked, or very, very close to having peaked in what we can expect to see for inflationary growth and interest rate growth. And reasonable confidence that within 12 months we might see interest rate declines again. So therefore the outlook for residential development in Victoria and in Melbourne in particular, in my view, is now back to being strong. And whilst the immediate conditions of the last 3 months or 6 months don't necessarily say that, the important thing is what can we expect to see in the next, say, 12 months, and certainly in the next 2, 3, 4 years. And so I'm going to give that an 8 or 8.5 out of 10. So that's my summary. I hope that's on the end of it.